How to buy stocks in 2023 is going to be vastly different than how we bought stocks in 2021 and 2022. In 2021, we had some of the greatest infusion of capital into our markets that we've ever seen historically in the past 100 years by the Federal Reserve. This obviously lifted the market significantly higher with bond buying, mortgage bond buying, and equity prices. In 2002, we saw this start to come to an end. The Fed stated they were going to stop buying bonds. They stated that inflation, while might be out there, looks like it's going to be temporary. During this period in time, we saw very high CPI numbers come out. We saw GDP come in. And towards the end of the year, we started to see layoffs. During 2022, the news headlines were significantly different. Tech giants plunging on fourth quarter results because they were so bad based upon how the economy changed, to the Swiss bank no longer having a negative interest rate policy that they've had since 2015. Brent jumping above $100 a barrel based upon the Ukrainian war. Europe concerned about supply of natural gas. Inflation reports that are putting stock under pressure. Of the Hang Seng hitting 13-year lows based upon draconian COVID policy. Now that we know where we've been, we have to figure out where exactly we're going. Now, in order to do this, I have my own beliefs about why this particular period of time is very close to 2000, 2001, 2002. I'm going to walk through that in today's video. The other thing that I did was go on the premise that I need more information. What do the big investment banks think are going to happen this year? At the end of every year, investment banks put together an entire thesis on what they expect to happen next year. I've read the top 12 of these, and the links are in the description below. I put them in an email format so that you can personally go through these yourself and take a look at them. The purpose of this is to look at my own bias and see if I'm aligned with what investment banks, also to see if there's any correlation between what the investment banks are saying. In other words, are they all in agreement, or is there unison in one particular industry? And I found a couple, but if you would like to read these investment banking reports yourself, the links are in description. Simply click on the link. BNY Mellon Wealth Division does an excellent job of stating what has happened and what will happen in the future. And I don't think that anybody feels that this is not factual. I think the timing of when this happens is somewhat debatable, but that these events will happen, the majority of investment banks and economists agree with. So we can see 2022, inflation hot, it's not transitory. Then we go to Fed hikes, the fastest in 40 years. Signs of slowdown, inflation peak, Fed slows down. All these things are factual, and they've all happened. Now, you hop into the beginning of the year, economy slows, inflation falls, Fed holds, potential recession. If there is or isn't is obviously debatable. Fed cuts, economic recovery begins. These unequivocally are the next part of the cycle. The question is just when. When that cycle plays out, or how long that cycle takes, depends on several factors. It depends on the global economy. The number one thing that the majority of investment banks agree on is that China GDP will grow. If we look here, we can see 2022 estimates, 3% was the consensus for Goldman Sachs in China. The consensus overall was 3.3. Now, Goldman is saying 4.5%, and then next year, 5.3%. The important takeaway from this particular graph are two things I want you to get. The world is 2.9. The world is 1.8 in 2023. This is a contraction. So they are calling for a contraction in GDP globally. At the same time, there is one nation we're talking about increased GDP growth, and that is China. And they're going all the way out to 24. Now, if you look at the US, we're looking at possibly 1%, and then they're talking about 1.6% in 24. Substantially different. JP Morgan goes on to say, however, a prolonged period of lockdown also appears untenable, and we expect China to experience an acceleration in activity as pent-up demand is released. While the timing of the policy changes remains uncertain, the market's performance has highlighted how sensitive investors are to any shift of an approach. ING Global paints three specific scenarios. They give you a base case, a positive scenario, and a negative scenario. So if we look at the base case, okay, they're saying sporadic lockdowns continue throughout the first half of the year. Domestic market growth outpaced external market with further easing of COVID into the second half of the year. That's the base case. Second part of their case On the bull side, all measures are lifted, retail production rebounds, and completed construction on homes begins. If we just kind of look from the base to the positive, they're obviously leaning towards being somewhat positive, but there's more to this. So if we look at their graph of real GDP growth, and in every single one of their scenarios, they still have GDP either going higher or at least staying at the same growth rate that it did before. BNY Mellon has growth of China 3.5% to 4.5%. US, they have negative 0.5 to 0.5 with inflation of 4 to 5%. Look at the substantial difference in inflation between the two countries. Citibank has 4.5% for 2023 with global GDP being 1.7%. Credit Suisse has China GDP in 2023 at 4.5% versus global 1.6%. Deutsche Bank 5% for 2023 GDP versus global 2.8% GDP. The key takeaway is twofold. Everyone agrees that China's growth is going to outpace global GDP. China is the only country next year that is going to have GDP growth. The easiest way to get exposure to China is FXI. It is the large cap ETF. Now, this is a weekly chart done in line formation. You can see the bottom here where we've already gone and touched the financial crisis level. Now, that's kind of interesting that we came there and we've already bounced off that level. And there's a couple investment banks that actually think that they are about a year and a half ahead of us, to maybe even 2 years ahead of us. Now, you just kind of see how we're wedged right in here on a weekly basis. And maybe we're at the low end of the range and maybe we're going to bounce up here. Honestly, I don't know because we're not really sure what they're going to do as far as opening. If we drill into this on a daily, we can see how we're respecting the upper end of the range and how the lower end of the range is still being respected. But by the DTL downward trend line in red, you can see very clearly that we are still in a downtrend. Creating a basket of names that are large cap China-based companies is probably not the worst idea, considering that that is where the world's investment banks think all the growth is going to be. Monitoring those through 2023 does not sound like the worst idea. Now, there are other ETFs. China's Internet ETF. My issue with playing just this straight ETF with something like China on the Internet is we just never know what the regulatory scrutiny is going to be. And that's why I think that you're better off creating a basket of the largest cap names. For example, let's take a look at BABA here on the weekly. Now, obviously, Buffett is a huge buyer of this. And if we take a look here on this weekly basis, we might be setting up a triple bottom. I do find it fascinating that we did touch the lows and we held. You can see by the DTL or downward trend line that we have broken over, but we really haven't confirmed. A confirmation move is getting over the higher high peak. So that puts you around 126, 127. This would be the name that I would watch. It has the largest institutional sponsorship by U.S. investment of any stock in China. Let's say your thesis is that China is going to have more of a negative outlook. Is the China 3X Bear Fund? And this would be something that you would add to your list. To me, quite frankly, it looks pretty washed out, but it's definitely something that seems to be finding some kind of bottom. Should lockdowns persist or should some other civil unrest happen, you could see a spike. So this is one that's worth watching. We are seeing a lot of comparisons in valuation to that of 2000. And it does make a lot of sense. In 2000, top 5 stocks were 20% of the S&P. In 2022, it was actually 25%. JP Morgan talks about this. S&P valuation started at 2022, not far off those seen during the dot-com bubble. If we just focus on growth stocks and that they are not cheap by historical standards, and you look at the world growth and value PE ratio, you can see where we're at on the pecking order versus where the mean might be. Now, this is all going on while earnings growth is coming down. Citigroup shows clearly how the NASDAQ is underperforming S&P dividend stocks. Fidelity walks through forward price to earnings and expects further downward revisions. Now, why this is important is because they are growth stocks that get hit the hardest during these times. If we look at their graph and we understand these standard deviations, and you understand that the chances of hitting the standard deviation are about 67%, well, then you can see where you're at on the average. And then if you come one standard deviation down, you still have pretty far to go. Currently, the top 5 tech stocks are 18% of the S&P. By the end of 2000, the top 5 tech stocks went from 20% to 5%. So one recurring theme is that these large cap tech names appear to be vulnerable. If we look at Apple, it looks like one giant head and shoulders. Looking at the weekly, it's even more pronounced. Microsoft weekly, we can see the DTL or downward trend line. We can see the test and holding the 200-week moving average. If we clone the downward trend line, we can see the channel. Drilling down into a daily, we can see the downward channel perfectly and how we are unable to get above the 200-day moving average ever since the death cross started. Google's daily is very similar. You can see the death cross and our complete lack of ability to rally. On the weekly, we can see that we are below the 200-week moving average and are struggling. Sun has a 200-week death cross. We have broken major support and are now currently sitting on minor support. It's very rare to have a weekly death cross. We can see with NVIDIA, we have the death cross, how we try to get back over and we're rejected, and where we currently are sitting right now. On a weekly basis, we can see the rejection even clearer, and we are trying to hold the 200-week moving average. Now, one of the things I keep hammering home in our Alpha Chasers community is, can the market go up with tech stocks going down? The answer is yes. This is value divided by growth. Very similar Citibank is doing here, where they are showing dividend stocks and how they're rising and how they're showing the NASDAQ is coming down. We are running right into a 15-year DTL or downward trend line, which we have rejected in 16. You can see if we go out only 5 years that we've already flipped the first DTL, which gives us a higher degree of probability of possibly flipping this one. The 10-year broke a 15-year DTL to break out. It's very possible that value is going to fall in line with the 10-year as PE multiples contract and dividend stocks become more attractive. So we know that value is going to outperform growth according to several investment banks, and there are signs that this may already be happening. Now, what value names should we be looking at? I'm focused on beaten down sectors that haven't rallied yet. We've already seen industrials rally substantially. Consumer staples are near their high. Healthcare stocks are near their high. So there's no real edge here. They may continue, but there's no edge. What we're looking for is alpha. We're looking for a dispersion. And when we can find those dispersions, we can profit from them. One such dispersion may be the housing sector and home builders. Housing stocks obviously get hurt by mortgage rates. But there's a lot of mitigating factors right now. Inventories is glaring. JP Morgan points it out perfectly. Look at the inventory level versus 08 to where we are now. And the population of the world has only gotten bigger. Finally, the impact of higher rates on mortgage holders is less to be seen. In the US, households did a good job of locking in low rates. 5% of US mortgages are on adjustable rates today, compared with 20% in 2007. JP Morgan goes on to say the risks of a deep housing-led recession, the type experienced in 2008, are low. Apollo points out that the unemployment report for October showed job growth in the housing sector. So while we're seeing contraction in tech, we're actually seeing more jobs in the housing sector. Now, home builders in general are down 2008 financial crisis levels, and I'll explain in a moment. But if you take a look here, we're getting the Golden Cross right on Toll Brothers, symbol TOL, Golden Cross on Pulte Homes, Meritage Homes, Golden Cross, KBH, setting up a Golden Cross. The majority of these companies are actually trading at their tangible book value. Linear, symbol LEN, is trading right at 1.09 of book value. You can see the minimum during the pandemic, the maximum of 2.5, and our median is right around that 1.23. So we're still at about a 20% discount to average. Toll Brothers is trading under book value, meaning if you took the sum of the parts and broke the company up, it's actually worth more. You can see the minimum is the pandemic level, but we're nowhere near even the average price to book. KB Homes only trading at 78 cents on the dollar. Average is 1.1. Stocks are pricing in the global financial crisis, but inventories are down considerably from them, which is keeping even though mortgage rates are at a 20-year high. The question is, what does the space do once mortgage rates flatten? Now, if you think that housing is going to get hit even harder and you're bearish, you would look at NVR. That is trading at 5 times its book value, which is considerably higher than any of the other housing stocks. What stocks are going to get hurt the worst in 2023 are those that need capital. If we look at the proportion of high yield bonds and loan markets that are in distress right now, we're just starting to see the forecast on how those rates are going to rise. In other words, how high the bond default rate could possibly go, how high the loan default rate could possibly go. This is going to make investment banks and also funds not want to lend money to highly levered corporations, which will increase their costs if they can borrow at all. In the 2023 letter by Apollo, who has a large, high distressed bond portfolio, people will remember that name as they are the group that bought the Carvania bonds when Carvania was at 100. Higher rates in QT have a strong disconnect between rates and equity markets. So we can see clearly how this is moving. Only the highest rate companies have been able to access the public debt market. The difference between 21 and 22. You have a decrease in 80% of high yield bonds, meaning those people can no longer access the bond market. 89% of leveraged loans. That's why a large swath of certain companies that I'm going to show you in a moment are really in jeopardy of losing their equity and, quite frankly, going out of business. The high yield bond market mostly shut down for new issuers. This shows you the rating. So if you're not triple B, hardly anything was able to get done in 2022. Especially as time went on. So in other words, you're watching bond market and access to the bond market shrink. That's very significant for what I'm about to go over. To start with, this is JNK. This is a high yield bond ETF and one that you can utilize to track what the high yield market is doing. It's never had a year like this where you just have that decline. The pandemic was a couple weeks and then a bounce. Last real decline back here in 15 to 16. Now, interestingly enough, if we look at the monthly on high yield junk, we can see how we came right back to the '09 levels, and we are actually at the level of the great financial crisis. Now, the reason for this might be the amount of SPACs, new issues that took place in 2020, 2021, and the amount of debt outstanding that has yet to go through the cycle. We are holding that 83.55, which we've never had a close below, but it does appear that support is starting to become resistance. You want to chart the performance of leveraged companies and you're looking for an indicator, you want to watch the high yield junk market. Should this gain some strength, it means that those types of companies are able to access the capital markets. This is Carvania. If you've been following along for some time, you know that we started shorting this right around here. Then we went through the trough, tries to rally, trough again. This is where they issued a large debt underwriting that was purchased by Apollo. The significance of this is that Apollo is highly plugged in to this specific fixed income market. They may have bought this for reasons going into bankruptcy, which obviously Carvania looks like it's going into. Now, there are two names that are absolutely glaring. One is Rivian. We all know that Rivian went public, ran up, pulled back, Ford exited. Now they're going to have trouble accessing the bond market. Support and resist are clearly defined. If we zoom in, we can see the left shoulder, the head, the right shoulder, and the break of the neckline. Now, what's nice about these names is you usually see some buying coming in to the end of the year and then in the beginning of next year for tax purposes. Currently, Rivian is trading at 16 times price to sales. To put that into perspective, Tesla is trading at 5 times sales. Now, currently, Rivian is just bleeding money. The net income in 2019, they lost $500 million. They lost $1 billion. 21, $4.6 billion. Now the loss is $7.49 billion. Eventually, no matter how much you have in assets, you're going to need cash flow. The way you're going to get cash flow is the bond market. Able to get terms at all for a bond issuance, which usually means they may have to do a stock issuance, which would depress the stock even more. Currently, there is $13 billion cash on hand. If we look at the cash on hand and the burn rate, you have about 6 quarters left. They're going to have to access capital in order to continue operations. For me, I'm watching this 1925 level. I think this has the possibility of going the way of a Carvania, quite frankly. It has nothing to do with the actual car itself. It has to do that you're no longer in a zero interest rate environment. And when you can't access capital, these companies just go out of business. We saw maybe 80 to 90% of the dot-coms go to zero. It was not because they were bad ideas or bad product. They just could not access the capital markets. Lucid is in the same exact boat, only it's a little worse. Lucid is currently trading at 30 times price to sales. Now, if we take a look at year over year, you're currently in 19, you were losing $250 million, then $750 million in 2021, 2.6 billion loss. Cash on hand currently at the same burn rate in the same car market. The burn rate we're saying stays the same for this example. It can get worse. It could get better. Using the current and not the fact that it's tripled year over year, you have $6 billion. That gets you another 8 quarters without finance. Technically speaking, I'd love to see a bounce back up to this neckline and then see if there's a entry spot in there. I'm not so sure if we're going to get that lucky or not, but it's really hard down here, even though you're trading at 4 times book value. It's still very difficult because of the massive move. So I'd like to see some kind of bounce before getting this on. Between Lucid, Rivian, and the others in this space, their debt structures are not going to be conducive to another car company coming in and buying them. So someone may come in and just buy the technology or buy the brand and start over. But that happens through equity going to zero. So those are some of the major trends that I see for 2023. To join the Alpha Chasers community, simply click the link in the top right and you will be added to the waitlist. All of the 2023 investment banking market outlooks are in a link in the description. Please comment on this format if you liked it, if you didn't like it, what more I could do. It's the whole purpose of me creating these is to inform and educate. And I'm having a great time doing it, but if there is something that you think should be added, I would love to hear.